Before we jump into the charts, I want to start with something that perfectly sums up this market right now. Stock traders cry over minus 5%. Crypto traders are down 90%, mentally unstable. They're dating an AI girlfriend and still, somehow, bullish on the next candle. Yeah, that's 2025 for you. But behind the memes, there's a very real story playing out. Markets are calm on the surface, chaotic underneath. So today, let's connect the dots: volatility, bank, gold, tech, everything. Because what's happening isn't random, it's rotation. The VIX has stayed under 25 for 95% of the last 700 plus sessions. That's not normal, that's apathy. When volatility compresses this long, it usually means two things. Either we are about to see a clean melt up or volatility shock that resets the board. And here's the kicker. The calm is happening while credit cracks and money rotates. So let's follow that flow. As you can see from this tweet, regional banks are bleeding again. Zion's down 10%, Western Alliance off 9%, that's credit risk quietly returning to the system. And at the same time, institutions have been deploying their cash. They have been buying puts 8 of the last 9 weeks, while retail has been smashing calls for 24 straight. That's psychology shift. Smart money hedging risk while retail ignoring it. Just like every late cycle before a regime change. The market isn't panicking. It's repricing who's in control. Meanwhile, gold has been quietly on fire. 9 consecutive green weeks, and in 4 weeks, it's added equivalent to 1.76 Bitcoin market caps. This isn't just a hedge anymore. It's migration. Liquidity flowing out of fragile credit into assets that hold narrative strength. And notice something. Every time banks wobble, gold accelerates. That's not fear. That's capital rotation. And then we get the headline cycle. Trump confirms a meeting with Xi in 2 weeks. Markets tense up. Traders hedge tariffs again. A few hours later, he's asked if 100% tariff still stands. And he just says no. One word and volatility gets crushed. This is how fragile positioning has become. The entire risk tone flips on a soundbite. And here, where's the money is going? Tech just saw 10 billion inflows, the largest single week injection in history. And healthcare, slow and steady, printed its first golden cross in 2 years. The last one, it sent prices up 13% in 8 months. That's liquidity rotation in motion. Capital's not leaving the system. It's rearranging its priorities. Now, Heisenberg posted this, and it's eerie. Current SPX structure looks identical to late 2024. RSI divergence on top, same neckline, same 50-day test, same VIX spike around 28. If the pattern repeats, we might be setting up for a fake breakdown before a new high. It's not guaranteed, but markets always rhyme. With all said and done, let's look at the charts now. That's what we are here for. Nasdaq has bounced out of this fair value gap quite incisively. Now, the only problem I see here is that it is an inside candle. So market is telling you that I am unsure. I am not sure which direction I still want to go in. And Nasdaq showing that sort of a reaction of a fair value gap, even though it is good, we still could not close above the open of previous week. We closed just on it. That gives me an indication that the market is about to either enter a consolidation for another week or two, or some sort of a breakout is on the way. And the more I look at this chart, the more I feel that breakout might not be to the upside. Now moving on to S&P 500. S&P 500 weekly candle was also an inside candle. We basically bounced out of this small fair value gap right over here. But for me, the draw on liquidity still remains to the downside, to these equal lows that are basically going to attract price very sharply. Once these equal lows are swept though, markets could reverse. Markets could make a decision to go either way. And that is where you basically position yourself. So for now, previous week's high, that was not the coming this week's, the week before. Previous week's high is what should be relevant for each one of you. You should look at this range as a trading range for your price. Every day you wake up, you just aim to go in one direction or the other. And these should be your targets, and you should wait once the target is reached to decide what direction the market wants to go in. Now moving on to gold. I gave you a price target of gold. At this point of time, I think 2 weeks from now. I gave you a price target of 200% and 250%, 400% and 450% of the acceleration gap that was formed in August. Then, last Saturday, I gave you a price target from the daily chart, and all those price targets have been met. And what did gold do on Friday? An engulfing candle which opened with a gap up, closed below the previous candle. This sounds more like a market top for gold for me. I'm not saying gold's gonna crash. What I'm trying to say is that we might have reached the first target in gold's mind. Now it's about where does this correction really ends. And if we look at the move that gold has made currently, we are still trading in premium. So I would be looking at the fair value gap that was in the golden pocket is this one. This will be the place where gold's price would want to reach out for. With this fair value gap and this order block trying to support price, if you want to buy gold, I would say 4074 to 4020 is the area that you should be looking for in the coming week. If price reaches that, it's going to be a good buy. Looking at dollar index, we talked about good dollar index last week, and I said I expect some sort of bullish price action to sweep this liquidity and then we head lower. And that's what we got. On the weekly time frame, even though it's a bearish candle, we have closed it nicely. Price is trying to go towards this liquidity, but the decision will be made once we have swept this one. If price can sweep this one and get rejected, my thesis will still remain the same, and I will expect a new liquidity sweep to the downside for DXY. Moving on to Bitcoin. Bitcoin is in a range of its own. But whenever you are in doubt and whenever you are scared, just zoom out. Look at this beautiful support, the trendline support that has basically been pushing price up from the bear market lows. It's just pushing it up again and again and again, and we are back at it. The only difference though is lack of acceleration. There is a very evident lack of acceleration above this high, and because of that I'm a bit concerned. If we are able to break below this support, I would be worried about Bitcoin, and I'll start looking at liquidity areas below. The liquidity areas being this low first, that's 98,000. If that is broken, I will start looking at this low. But even then, you cannot just look at the lows. You also need to look at the range. The range currently, the price is in premium. There is a fair value gap right over here, which will be your major support, which will be the area where I will be positioning myself for Bitcoin. So sub 90k, maybe around 86 to 85k Bitcoin, that is a good buy, because the target still remains somewhere in the region of $157,000 and $151,000. So a position from here with a stop under this low would be a great risk to reward trade for Bitcoin. Ethereum is now looking bad. And why is it looking bad? Now let's look at Ethereum as a whole. We are basically trying to enter the sell side of the market maker model. Initially, we deviated, consolidation, pump, consolidation, pump, now consolidation, but towards the downside. But I have this short position, which I'm part of. If this position gets stopped out, the only thing that you need to worry about after that is higher prices. And the targets are pretty clear, 7,000, 8,000. So this is my hedge against my long-term position. And if this position is going to get stopped out, I'll straight away open a long position and start targeting towards 7,500 area for Ethereum. So I'm not bearish. Yes, it's an extended target, but the extended target is to hedge myself against the positions that I've been in. Overall, I'm still bullish until and unless we break below this channel that was created in 2022. So once we are below this, that's when I will be really scared with Ethereum. And I'll be very happy with my short position that I opened, because that will hedge my long positions and I can basically reduce my risk overall. Moving on to Solana. Solana has broken down. We talked about this on last Saturday, and I said that, hey, we are breaking down from this whole little range. It was a bearish range. Price went back into the golden pocket, got rejected. Now we are trying to create a double bottom structure. All you have to understand is, though, we have only swept this liquidity. This could be enough because these were equal lows. But there is liquidity lying below. There is 0.618 on the negative side lying below as well. So keep your eyes on Solana. Don't get overextended on your positions, whether it be towards the upside or downside. Just remember, wait for market to tell you where it wants to go rather than you trying to anticipate where the market wants to go. Once you are able to feel comfortable with your position, that's when you should enter. And you should not enter based on, I think this is going to go up. You should enter once the market tells you I want to go up. And for me, Solana will tell me that it wants to go up if it can show me displacement above this high. Once you have displacement above 210 area, it's a clean long. I'll be part of the trade with you. But until then, with Solana, I'm just going to stay on the sidelines. So yeah, it's easy to laugh at memes and scroll through headlines. But if you look closer, there's a silent rotation happening. From fear to flow, from risk to resilience. Volatility, calm, credit cracking, gold rotating, and tech inhaling liquidity again. This isn't noise. It's the next setup. Trade narrative, not headlines. Thank you for watching Squid Traders. Subscribe to the channel for live trading sessions with me every Tuesday, Wednesday, and Friday.